Hello everyone, and welcome to today's webinar, Exploring For-Profit to Nonprofit Conversion. My name is David Pulio, and I'm a member of Foley & Lardner's Marketing Department. Before I turn the presentation over to our speakers, I would like to go over a few housekeeping items. Today's program will last approximately 1 hour, followed by a short question and answer session. We encourage all of our attendees to submit written questions during the program. Please type your question into the Q&A widget open on the left-hand side of your screen. We will respond to written questions at the end of the program. The webcast console you are looking at can be completely customized. You can resize or move any of the windows that you have open, including maximizing the PowerPoint presentation on your screen. If you experience technical difficulties during the presentation, please visit the webcast help guide by clicking on the Help button below the presentation window, which is designated with a question mark icon. The PowerPoint presentation will be available on our website at foley.com in the next few days. You can also get a copy of the slides in the resource list widget open on the left-hand side of your screen. As a reminder, the program will also be recorded and also be available on Foley's website in the upcoming days. Foley will apply for CLE credit after the web conference. If you did not supply your CLE information upon registration, please send an email to me, that's David Pulio, at dpulio@foley.com. To be eligible for CLE, you will need to be logged in and viewing the webinar today, and you will need to answer a polling question posted during the program. As a final note, those seeking Kansas, New York, and New Jersey CLE credit are required to also complete an attorney affirmation form in addition to answering the polling question. A code will be announced during the presentation. You will email that code and that form again to me, Dave Pulio, at dpulio@foley.com immediately following the program. At this time, I'd like to introduce our presenters for today. We have with us three Foley attorneys. Richard Riley, Jr., Dick Riley, is a partner in Foley's Washington, D.C. office and a member of the firm's taxation practice. His practice focuses on representation of tax-exempt and nonprofit organizations with attention to transactional matters and corporate governance. David Sino is a partner in Foley's Milwaukee office and is a member of the firm's transactional and securities practice. Mr. Sino regularly assists public and private companies with mergers and acquisitions, strategic alliances, and various commercial transactions. Jason Cahoot is a senior counsel and also practicing in Foley's Milwaukee office. Mr. Cahoot is a member of the firm's taxation practice as well as the estates and trusts practice. His work encompasses all areas of tax and corporate law, and he focuses primarily on the areas of tax-exempt organizations, charitable giving, and political and lobbying law. And I'd like to now turn it over to our presenters. Gentlemen, go right ahead and have a pleasant presentation.
Thank you, Dave. Well, I appreciate everybody on our conference call and webinar today. This is Dick Riley. I'll handle the initial portions of the presentation when we'll start with fairly high-level discussion of the economics of converting a for-profit educational company or organization to nonprofit tax-exempt status, and again, some high-level accreditation and regulatory issues that impact the transactional side. This is not a seminar on education law or regulation. So just to be clear, this is what we're really talking about is the deal, structuring and consideration of the deal and the economic issues. My colleague Jason Cahoot will then cover transaction structuring and the very important issue in the 501c3 tax-exempt area of addressing and reducing the risk of conflicts of interest. So basically issues, the details of the corporate transaction structure in a for-profit to nonprofit conversion and the conflict of interest issue. And then our corporate partner, David Sino, will discuss completing the transaction, more of the practical details of the actual, the actual agreement, the implementation of the designing and implementing the contract to perform the nonprofit conversion transaction. So let's move to the next slide, which is, as we call it here, basic nonprofit conversion economics. And another thing, I'll just mention at a high level, again, it's not really the focus of our presentation, so we don't even have a slide on it. Why is this of interest to a number of for-profit education companies these days? I'll largely leave that to our audience to consider on your own. Certainly we all know that the gainful employment regulations are out there putting substantial economic and legal pressure on the for-profit education sector. And there may be a variety of other reasons to perform nonprofit conversions. It could be family and succession planning, simply a desire to move into the nonprofit sector. But, a wide variety of reasons these days are compelling for-profit education companies to consider conversions of this kind. So let me just go over, these are, as we've said, high-level economic and corporate considerations as for-profit education companies consider transactions like this. The basic thing to remember is that, and this is virtually the definition of nonprofits, nonprofits don't have owners. The nonprofit organization sometimes has no voting members at all, and its board of directors simply elects its own successors, or nonprofits sometimes have voting members, but their interest in a nonprofit corporation is really limited to voting rights. So no one can receive dividends or a distribution of profits from a nonprofit corporation. So that's the basic legal key to remember about nonprofit organizations in general. A nonprofit conversion is a sale of the for-profit educational operations and assets to it. At the end of the day, it is a sale. There are a wide variety of structures that can be used, but it is a transfer for consideration of the educational operating assets to a nonprofit entity, or at least into nonprofit form. The owners of the for-profit educational company give up their equity in the for-profit company and receive consideration in the form of cash or debt. And that consideration is measured by the current value of the university as a practical matter, determined by professional outside appraisers. And we'll get into the appraisal and quote-unquote comparable sale issues later in the presentation. But that is what the owners get. So shareholders, they receive cash or debt in exchange for giving up their equity stake. And a point to, a very important point to keep in mind here, as certainly everyone on the call is well aware, the education industry, the education community is highly, highly regulated, as we know. And certainly the terms of your debt and the other economic terms of a nonprofit conversion transaction are subject to review by the accreditors and regulators that govern your company and its operations. We wanted to mention that so generally a nonprofit conversion will involve a transfer to another legal entity, typically a pre-existing nonprofit entity, which could be pre-existing for a long time or relatively newly created. But you could, in principle, and we mention this because people often ask about it. You call it nonprofit conversion as a shorthand term for the kinds of transactions we're talking about. Could you simply convert by switching around the existing corporation? You could, in principle. You could adopt in some states. And some states do allow a for-profit corporation, a proprietary corporation, to become a nonprofit corporation eligible for tax-exempt status by simply adopting the appropriate language in their articles of incorporation. But you should note that it at least would be pretty tricky in a circumstance like that to find a way for the owners to get paid in that circumstance, because there's no actual transfer, simply a conversion in place. So basically that would amount to a contribution of current value to the nonprofit entity with potential tricky questions about the extent to which any tax deduction would be available for that so-called conversion. But that's basically what we're talking about. It turns from proprietary to nonprofit, i.e. no dividends status, and generally accomplished in the form of a transfer. Now, the other important facts to remember are that there are a series of allowable sources of economic benefits back to the current shareholders. But we mention here, and this is the guiding principle in the nonprofit and tax-exempt world, any payments of any kind that are paid back to the owners or existing officers or executives of the for-profit education company are subject to the constraint of fair market value. The owners, shareholders, officers, and directors of the existing entity can get no more than the value of the fair market value of the property and services that they provide. So that is the legal constraint. And again, that's simply a consequence of the fact that no profits can be distributed once the entity is a nonprofit, and therefore the only payments that are permissible back to the current shareholders and officers and directors and key employees are nothing more than what they're providing, the fair market value of. So, and we've listed some items here that, these can be important factors. Rent, fair market value rent for the facilities of the for-profit educational organization, now nonprofit. Administrative services of various kinds. Licenses to the extent that that the name, for example, the logo and other kinds of marketing goodwill remain in the hands of the prior shareholders. Compensation, of course, is a significant one, and one that gets, needless to say, very substantial scrutiny from both the tax authorities and the regulators. So, assurance of a compensation review process that makes certain that no excessive compensation is paid, it would typically be an important part of the transaction. But again, we want to reiterate at the bottom of this slide, what you can't retain is any kind of profit or dividend-like interest. There can only be transactions for the fair value of goods or services provided. So again, just staying at the high level for the time being, benefits of tax-exempt status, and let me just mention here, nonprofit and tax-exempt are not synonymous. Nonprofit corporation is a matter of state law. Those are, corporations created under the State Nonprofit Corporation Act, and they typically are corporations that are precluded under state law from paying dividends or distributing profits. As we said, it's kind of the meaning of nonprofit. In this case, the nonprofit entity that, following the transaction, will own the educational organization also will be tax exempt. It will be, the typical, well-recognized Section 501c3 educational organization, like any, like any private university, school or university. So in this case, we'll probably end up using nonprofit and tax exempt more or less interchangeably in our presentation, but because for this purposes they're essentially the same. But remember, those two terms are not generally synonymous. So what's the main one? The important benefit is the new entity does not pay federal income tax on its profits. It is exempt from both federal and state income taxes, although it is taxable, as mentioned here. There is a corner of the tax world that still applies to tax-exempt entities called the unrelated business income tax on activities that are not related to the now educational mission of the new school or university. That's a tax wrinkle. That's simply something to be addressed in the future. Tax professionals need to address that. Because the new entity is a so-called 501c3, contributors get a tax deduction. Now, typically, there may or may not be much of this, much in the way of charitable contributions made to the new operating educational entity, because, again, its mission at this point is to run the school, run the university. But certainly, for example, and I think this could be pretty common, the new nonprofit educational entity could create an internal scholarship fund and may well solicit contributions for that purpose from businesses in the community or communities in which it operates. So because the new entity is a so-called 501c3, contributors are eligible for tax deduction. So that's a potential tax benefit. Sales tax and property tax are very much dependent on state law, and it really does make a difference. Almost every state is narrower in its grant of both sales tax exemptions and real property tax exemptions. Not every 501c3 federally tax-exempt entity is eligible either for state or local sales tax exemption or state or local real property tax exemption. So those are always issues that have to be addressed. So again, just to be very clear about this, taxable property in the hands of the for-profit educational company that went into the deal may well stay subject to state and local ad valorem property tax. And then finally, 501c3 organizations are eligible for preferential postal rates from the U.S. Postal Service. And again, that's something that needs to be covered, as the deal is planned. Items to keep in mind are that the board of the nonprofit entity needs to approve the deal, and that has to be done in a way that is demonstrably independent of the governing board officers and directors of the for-profit company that is entering into the conversion transaction. You have to set up an independent governing board at the outset so that you have a body, a corporate governing body, that can confirm that no more than fair market value is being paid and that can enter into the conflict of interest procedures, the IRS specified conflict of interest procedures that we'll mention in a little bit. Another point here is that the accreditors, again, I'll just reiterate again, obviously we're in a heavily regulated space in the educational world. The accreditors will oversee and comment on and potentially force changes in. We've certainly seen that. The economic terms of payments. How much liquid assets, for example, is required to go to the new nonprofit educational operating entity? What kind of debt ratios are required in order to continue to make, for example, payments on the promissory note back to the owners that have, entered into the transaction. So another important thing to remember is that the economic terms of the deal are subject to regulatory scrutiny and approval. And our experience is that the accreditors and regulators will be more demanding than you think. So that is an important thing to keep in mind. Just a couple of other points before I hand this over to Jason to talk more about transactional structuring is, again, just to reiterate, these are heavily scrutinized transactions from the regulatory end, and then at the end of the day, there will be quite substantial disclosure obligations to the Internal Revenue Service. That they're after the fact disclosures and descriptions of the deal, disclosures of the nonprofit organization's articles and bylaws. These things take time. Again, it's a regulated industry. I would say at an absolute minimum, we're talking about a transaction that requires months of preparation, and again, maybe close to a year, just to be realistic about it. Part of the issue here is that, and again, accreditors and regulators will typically require this, that you need to have kind of a governance structure in waiting even before the transaction closes, so that you can seamlessly transition to the educational organization's actual post-transaction nonprofit governing board. And so that's just a practical item to keep in mind. Sort of put the board in waiting is a term we've used when we've been involved in this. Put that in place. And then simply you should expect that there will be revisions to the deal terms, as we mentioned. The regulators and accreditors will have something to say. A couple of other points, just, again, trying to alert people to outside constituencies that may, not necessarily, but may have an interest in a transaction like this. State attorneys general are the traditional state law enforcement authorities with power over charitable trusts, charitable corporations, and charitable trusts. So in many large states have activist attorney generals that police the nonprofit sector pretty carefully. So that is a potential constituency for a transaction like this. As we mentioned here, it does depend on the state of incorporation. And again, not to be too wary or negative about this, in many states, the state government and the state attorney general will welcome the transaction. The moving from for-profit to non-profit, has appeal for many law enforcement officials. So just be aware that they are a potential constituency here, not necessarily a negative constituency. And then finally, to the extent there's a risk of gaining, in this case, gaining property tax exemption for the educational organization, there may be a negative interest on the part of the local community, and it really depends on how much a property tax exemption is really going to be available after the transaction. That is the high-level overview we wanted to give, and I will hand it over to my colleague Jason Cahoot to talk more about the details of transactional structure.
Thanks, Dick. This is Jason, and just as Dick said, he has been talking about the very high-level concepts with the conversion, and now we'll kind of zoom in a little bit and sort of talk a little bit more specifically about what legally and tax-wise a conversion would entail. So when we talk about or we think about how to put together a deal like this, there's a number of different issues and constraints that we think about, and they're unfortunately specific to each sort of each of the circumstances that an entity would find itself in. But we have a number here that we want to think about when we're kind of drawing the boxes, which we'll show you in just a second. The first one is whether the for-profit organization has a 501c3, an organization that it would like to work with. Unfortunately, this gets very complex, but you have to have a particular kind of 501c3. Many company foundations or tightly controlled 501c3s are what are known as private foundations. Those won't work. We need a public charity, what's called a public charity, so we have to be particular about what kind of 501c3s, but if you have one that's already in existence, it may make things easier. Secondly, we have to look at the state law. So for the most part, for-profit entities, corporations, LLCs, can easily convert from one to the other under state law. That is not the case when we talk about non-stock corporations, or as Dick explained, corporations that don't have stock. So in a number of states, those conversions, mergers, any sort of state action may not be allowable, or it may come with a set of other requirements that we have to deal with. So state law is an important aspect to this, as is federal income taxes, both for the shareholders and for the corporation itself. When we talk about income tax to shareholders, as Dick explained, for economic purposes, we are talking about a sale, and mainly for tax purposes, this will essentially be a sale. It could also be a charitable contribution in part, but it's primarily a sale. When we talk about structuring the income tax consequences, we have to be cognizant that in many cases, you're going to have a deferred purchase price in that. We'll have an agreement on day one, but for some years after the agreement, the nonprofit or whatever, the consideration will be paid on a deferred basis. So for many years, the shareholders will be receiving a payment, probably a payment on a promissory note. We have to make sure that we receive installment sale treatment so that on the year of sale, the shareholders are not tagged with an enormous amount of income and income tax that they're going to be responsible for in that year or the year after. And while they're receiving their cash, the proceeds of the sale, over a number of years, like 10 or 20 years. So we have to make sure that we're focused on a structure that allows the shareholders to receive that installment sale treatment. We also have to think about retained assets. Are we going to retain any assets like administrative services or investments and reserves that the university corporation has built up over time? Now, how are we going to take care of those in a tax-efficient manner? In addition, and this is a difficult pill to swallow, but it is the case that when you convert a corporation from for-profit status to nonprofit status, that conversion or that merger will be treated as a sale of assets and a complete liquidation of the corporation. So you really have quite a bit of tax that could come into play here. So we have to think about how are we structuring this transaction to make sure that we have just one sale. We have the sale of the assets or the property, or for tax purposes, from the for-profit to the nonprofit, and then we're making sure that that sale is subject to installment sale treatment so that we're not paying a whole boatload of tax in the first year and making sure that the tax is being paid over a number of years. And then in addition, we have the legal contracts. When we move assets from one entity to the other, it's a fairly simple process, but when the university as a for-profit has engaged and entered into contracts, those contracts will have to be shifted over to the nonprofit Section 501c3 organization. How we do that, if we're able to do that under state law, if we're able to say, because of the structuring mechanism that we used, that the university, the new nonprofit, can simply, under state law, step into the shoes of the for-profit entity that signed the original contract, we're in a much better situation than if we have to go to the the other party in the contract and ask them to do that or ask them to consent to that process. And then lastly, always, it probably should have been the first part of our list, it's the licensing and the accreditation. We're shifting entities here, and because of that, that may trigger regulatory approval requirements and all sorts of other things. So we have to be very cognizant of that. But also, when we're structuring, is there a way to avoid those issues? So we're going to show you some boxes. These are all very, you'd say very sample and very simplified. But here we have our sample for-profit university structure. We have the shareholders. They own the university corporation. The university has operations, so that's actually the university itself. That's the business of the university. And then I've added here the wrinkle that we have assets that the shareholders would like to retain. So assets that, for whatever reason, they aren't going to the nonprofit. They might be administrative services. They might be some aspect of the university that we're keeping, or maybe investments, something like that. So as Dick said, we'll go through it because it's the simplest one, but I think the conversion in place, there's some issues with it from both a legal and tax aspect, but it is the simplest one, so let's start with it. So here, we have our shareholders, university corporation, university operations, and assets to be retained. So in this case, we're just going to convert the corporation as is. The first thing that we'll do, and I put the number 1, the step 1 at the bottom because it's right beside our assets to be retained, the university corporation will distribute its retained assets, the assets that it wants to keep, to the shareholders. So that will go up. That will be our first step. The second step is that the university will adopt a plan of conversion, and the shareholders will all sign on to the idea that the university corporation is going to become a non-stock corporation. And then lastly, under the plan of conversion that we just talked about, the shareholders will agree that their stock will terminate, so they'll no longer have stock, and then they will receive either promissory notes or some other consideration, but generally promissory notes in exchange for their stock. So when we're all done, the picture doesn't change much, except that the university nonprofit, which used to be a for-profit, has been converted and it doesn't have any shareholders. The shareholders are now debt holders because they now receive promissory note payments. And in this case, I've just added this, again, this wrinkle that some of these assets and the shareholders may want to provide services to the university going forward. So if there's some sort of back office aspect or real estate, that'd be another good example, right? The shareholders wanted to retain the real estate, and now they're renting it to the university nonprofit in exchange for rent payments. That may be possible. So that's what we're showing here. The university nonprofit is paying promissory note payments, as well as, in maybe in that case, rent. They're paying rent to the former shareholders. And very quickly, you can see some of the advantages here. This is very simple to understand. The conversion process, again, there wasn't much in the way of boxes to show you because we just changed one box from a for-profit to nonprofit. In addition, you can also see that the nonprofit corporation is a legal successor. If you have a conversion statute, it usually says after the conversion, the successor, the newly created, not newly created, but the corporation, the non-stock corporation, steps into the shoes of the for-profit entity. So there's a corporation throughout. It just now doesn't have shareholders. A huge disadvantage is that this is probably not available in a large number of states. You have to look at state law. Many states do not allow a conversion of this nature, or they would include so many different requirements that we wouldn't be able to do it as a legal matter. The other kind of issue, and Dick was alluding to this sort of start running in place. When the day before you have a conversion, you do not have a 501c3, you do not have a non-stock corporation, and then magically it happens in one day and you convert, you file with the state, and it's done. The problem is that all of these administrative things are required to be done, to be, just kind of starting to run. Things like bank accounts, EIN numbers, payroll. You're going to start to move to a system, but you start essentially standing, right? You start the day after the conversion is effective. And regulators and, frankly, your business people may look at that and say, gosh, we're not able to set up anything beforehand. Well, the problem is you're not 501c3 before the date of conversion. So that means you're not, again, you don't have that running start. You're not able to kind of set up the part of the business that needs to be in operation on day 2 after you've converted. And one of those things is the 501c3 status. So if you convert on day 1, we can file the form with the IRS on day 2, but it may be months before we actually have a determination of your 501c3 status, which means that a lot of people are going to ask for that letter and you won't have it. So again, could be another issue. And then lastly, as we distribute out these assets, they may be subject to income tax. So another way to do this as a structuring is essentially to sell the assets of the university to a new or current nonprofit. Very simple, right? We have, again, our structure here. We create a new nonprofit. The university corporation just sells the assets of the university to the new nonprofit. So we have the completed structure here. Looks very similar, right? Shareholders, they haven't sold the corporation. They haven't sold their stock, but the corporation has sold the university operations and all the assets of the university to the new nonprofit university. The new nonprofit university, in exchange for receiving these assets, makes payments on a promissory note to the university corporation. University corporation probably distributes up those assets, or sorry, those payments to the shareholders, and they receive the cash. Can get a little bit more technical after when taxes are considered, but nonetheless, pretty simple, pretty understandable. So the advantages are, again, it's simple. The other primary advantage, I think, is that you have a new nonprofit university, and that can be formed any day before the actual sale. So you can really be forming this, 4, 5, 6 months ahead of time. You can go to the IRS and qualify as a 501c3 in advance. You can have that letter on the date of, in this case, the sale. And you can also do all the other administrative activities. You can open the bank accounts. You can have a new EIN number. You can have payroll set up. You can really operate, and I think as a business matter, this is very important, you can really operate administratively as a shell organization, and then the date of sale, you just transfer the operations over, but you've got all these different things already put together, including maybe a board of directors. You know, that your regulators are going to want to see your board of directors. That'll be very important. You can have them meeting, and in fact, they will have to approve the actual transaction. Disadvantage is, as Dave will talk about, when you're transferring assets and you're transferring contracts, that's always between two entities. That's always a little bit of difficulty. We have to make sure we get all the assets retitled, and we have to make sure that if there's contracts, the contracts have been validly assigned. And in addition, this is a new entity, so we have to think about the licensing. The last one we'll talk about is a merger, and that is, in this case, we would form our new nonprofit, just like in the asset sale. We would then distribute our assets to be retained, just like in the asset sale. But instead of selling the assets, here the shareholders essentially sell the stock of the corporation to the new nonprofit. The corporation merges into the new nonprofit, and the new nonprofit provides promissory notes to the shareholders. Legally, a merger is, in this case, very much like a sale. The shareholders are receiving a promissory note in exchange for their stock, but crucially, legally, the corporation and the new nonprofit come together, and the new nonprofit is the successor organization. Legally, for contractual purposes, the new nonprofit then steps in the shoes of the university corporation for all sorts of contract and licensing purposes. It is what we call the successor of the university corporation. So if we go here to the completed merger, the university for-profit corporation itself has entirely went away. It terminates. All of its rights and assets go to the university nonprofit. So we have the university nonprofit owning the university itself, and it is making payments to the former shareholders through promissory notes. And then also, as I said, maybe we've retained some real estate. The former shareholders are now being paid for the real estate that they retained before we completed the merger. So we'll talk a little bit about the advantages here. I think it's pretty clear. I've explained the real advantage, and that is that the nonprofit entity becomes the legal successor of the university entity. So maybe we're talking about far fewer contracts that actually have to be dealt with at the sale. And then the other advantage is that the shareholders are not holding on to the liabilities of the university, or the retained assets are not subject to the liabilities of the university. Any liabilities that occur move over to the new nonprofit. And then the disadvantage, of course, always have to be looking under state law. This may not be available, or again, it may create other issues that we don't want to invite, so we're stuck with another form to actually do the conversion. So it gets more technical, like I said, as we look at some of those issues and considerations, but nonetheless, those are sort of our basic, it's our basic toolbox to work from. So, as Dick alluded to, we have to deal with conflicts of interest. You'll notice in all of the suggested ways to do this, we're dealing with a new nonprofit that, frankly, I mean, it really depends, but, we have people on both sides of the transaction. Generally, I think people who are, if you're thinking about converting your entity, you don't want to be done with it. We just talked about how you might want to receive compensation. You might want to just sit on this board of directors because this is your life's work and you want to have some ability to guide it. We're dealing with a new entity that, for the most part, the people who have been involved in operating the organization, the for-profit entity, will want to be involved in this nonprofit during this formation and during this transaction process. So what the IRS says is that's great. That's a conflict of interest because you're on both sides of a transaction, and you could benefit from could economically benefit from the for-profit aspect of this because you're going to be receiving payments from a nonprofit entity, but you have to address it. So we have to take care of business here. So we look at the IRS technical rules for this, and that is the IRS says 501c3s cannot be operated for a private purpose. They cannot provide what they call private inurement to private parties. Very specifically, the tax code says it prohibits or penalizes those who provide excess benefit. That's the technical word in the tax code to people who are interested, so officers, directors, and substantial contributors of the 501c3. These are rules that we have to address in both the conversion transaction and any other transactions in which we have, again, somebody on either side of the transaction. If you have the person who used to own the university who's now being paid as a president, then that compensation agreement will have to be subject to these rules and procedures that we're getting to in a second here. So when we talk about excess benefit, we are trying to avoid, again, a bunch of terminology, but we're trying to avoid intermediate sanctions, which are essentially a bunch of penalties that apply if we don't address our conflict of interest issue. Intermediate sanctions apply when an organization pays the excess benefit to an officer, director, or individual with substantial influence of the organization. An excess benefit is sort of just exactly what you might think from those words, from that phrase. It's essentially any benefit that is in excess of what a person would be otherwise entitled to receive if they were an independent third party. So, for example, in our asset sale, if we sell assets that are worth $100 to the nonprofit, and the nonprofit pays the corporation or the shareholders $200, we have $100 excess benefit because $200, our cash consideration, versus the value of the assets, $100 equals $100. But, and this is the key, right, that if the nonprofit pays $100 for the assets, and the assets are valued at $100, we don't have any excess benefit. So that's the biggest, most important thing we have to do is make sure that our consideration is essentially fair market value, because then we don't have an issue under these rules. But the IRS actually goes further. It allows a procedure, it gives us this procedure under which we can have what we call a rebuttable presumption, a presumption that this is fair to the organization. The IRS may rebut it, they may find some other information or evidence, but they will presume when they look at the transaction that this is fair to the nonprofit if we meet certain requirements. We have advanced approval of an authorized body without a conflict of interest that relies on adequate information. So if we look at the next slide here, we actually have those elements broken down for you. Authorized body, reliance on appropriate comparability data, approved in advance, and documented contemporaneously. Not very difficult. So we'll go through them one by one here, but actually fairly quickly because they're pretty self-explanatory. There's two pieces of important information to understand about the authorized body. One, it has to be able to engage in the transaction. It must have corporate authority to actually pull the trigger and agree to the merger agreement, the asset, whatever Dave cooks up for us. It has to be able to actually authorize to enter into that as a matter of corporate law. So you can do it two ways. You have the board of directors minus the people who have conflicts of interest, or you can assign it to a special executive committee that under state law would actually have authority to enter into the contract. Either one works, but the key is that you cannot have the people who have conflicts of interest participating in the votes to actually undertake the transaction. So they can present the information, they can be there, part of the discussion, but at some point you have to say, look, we're actually going to discuss this without the people who have the conflicts of interest, and they have to leave the room. We have to write down that they left the room, and then that board, that authorized body, can actually go and approve the transaction. So the IRS says comparability data. Make no mistake about it. What they're actually saying there is that you need to go get a third, a independent appraisal, probably from the best independent appraisal firm that you know of, or that that you can find, because the IRS is going to scrutinize this pretty hard. This is where they come in and really make sure that it's been done correctly. So your appraisal needs to consider comparables. It needs to consider industry trends, and frankly, it just needs to be making sure that it is looks at all the complexities, that you're very comfortable with it. It should be thick. It should just look good, and it should look like somebody did some important work and that they knew what was going on in the industry. And then the last point is that, as Dick has said, you can really save a lot of money by not having to pay property tax. But that aspect, that benefit, should not be taken into account in the appraisal to determine what for-profit shareholders or individual shareholders receive from this transaction. We have to make sure that that's not in the appraisal, even though it could be a large amount of money. And then lastly, this has to be approved before you enter into the transaction, but we also have to make sure that afterwards we get it down in paper. And if there's ever it's one of those things where you just have to be very, very careful about what's in that documentation to make sure that you're checking off everything that's needed. I have a list here, and you can read it on your own time, but it's very important that you have went through, and the rule is within 60 days or the later of 60 days or the next time the committee meets, but I would be the next day be worried about what's in the minutes. I'd be focused on the resolution that was approving the transaction to make sure that everything you wanted in there is in there. And then I'd be writing the minutes the next day, and I'd be looking at the regulations to be very clear about, okay, we hit this, we hit this, we hit this, put it all together to make sure that when the IRS calls, and unfortunately the IRS, they won't call in the next month, it'll be 2 or 3 years, to make sure that you have a very good position, that you've done everything that you've needed. So with that, I will turn it over here to Dave.
Thank you, Jason. Next, I'd like to give you a brief overview of the transaction process so you have an idea of what to expect. So as Dick mentioned, this is a process that usually takes months. It's certainly not a process that takes days. It's all about details, details, details. It is a long and complicated process, and you will spend at least half of your time will be used in managing and executing the sales process. Most of the time will be involved in due diligence, which we'll talk about here in a minute. But really the question you need to ask yourself is, can you work the sale or the conversion and run the university? It's a challenge in any kind of sale of a company or a business, and you will certainly be confronted with that as the process moves along. Of course, the first step would be in any sale or conversion would be to assemble your transaction team, which start, of course, with your management team. You need to determine whom you want to bring over the fence, so to speak. The general rule is, people who only need to know should know. That would be, your key executives, your key employees, president, CEO, CFO, etc., to kind of keep the transaction on confidential terms as much as possible as you can. Of course, you'll have to assemble your legal advisors. You may need to look into hiring special transaction counsel to do a transaction like this. Your accountants and, of course, the valuation firm that Dick and Jason mentioned as well will be key to get this process started and completed on time. One thing to keep in mind here throughout the transaction process is to try and keep it as if you were dealing with an unrelated third party on an arm's length basis. The idea being the regulators will look for that, so you want to see all the types of agreements, terms, etc. that you would have with an unrelated third party, including a confidentiality or non-disclosure agreement. You'll be disclosing sensitive proprietary information to the nonprofit once that entity is established or is already established, including financials, other operational information. A confidentiality agreement will help preserve the confidentiality of that. Importantly, of course, you also need to keep in mind how to try and keep the deal and the terms and the transaction confidential within the existing for-profit university. Suggestions on that is to develop an information protocol early. That is, what do we do or what do we say when someone in the community learns that we might want to try and convert to a nonprofit, and what does that mean? If somebody calls, what do you say, or who says it? Appoint a lead person to kind of, all inquiries be routed through that person. Those types of controls are important. Second, a term sheet or the material terms of the transaction. Each of the boards, your for-profit board, your shareholders, your nonprofit board, are all going to need to know what the terms are. A term sheet, so to speak, letter of intent, would certainly be helpful there. The key there is to make sure it's non-binding, and there's no legal obligation to pursue a conversion or a sale, but a term sheet is helpful. Can show the regulators that, yes, here's the structure, that one of the three that Jason walked through, either conversion, an asset, or some sort of merger. Here's the cash component, if any. Here's the promissory note, the terms of payment, etc. Here are any retained assets contracts. Just kind of, again, a summary of the material terms of the transaction. A transaction timeline and a working group list, of course, those are more organizational matters, but those are usually very helpful in trying to get the transaction, keep it on course, and get it to the desired closing date. The next phase is university due diligence. That is kind of reviewing the operations, the contracts of the university to see if there's any issues or problems that could arise in connection with the conversion or the transaction. For example, these are consents and notices outside of all the regulatory consents that you'll need, such as a textbook vendor or a landlord or a debt holder, a bank. What consents are needed when you undertake that transaction? Does that contract you have with your textbook vendor, does it have an anti-assignment, meaning you can't transfer that contract to the new operating entity, the new nonprofit operating entity, if you're going to do an asset sale? Do you need to get their consent? What's the likelihood of getting that consent? Same analysis of the landlord and the debt. If the university has debt, it's likely will need to be paid off because a transfer or conversion will likely be default. So those are the types of things you're looking for in diligence. Any issue or problem that it could impact the timing or the closing of your sale or conversion. As noted here, the information that you gather and sift through for diligence will also be used to prepare the disclosure schedules, which are an important part of the definitive on a purchase agreement or sale agreement, which we'll talk about next. Due diligence, the timing, of course, is to start as early as possible. It takes a long time. You'll find yourself working with your accountants and your lawyers, sifting through all this information, and the earlier the better to try and tease out any issues. Some key things to think about in diligence and what will need to be reviewed is the ownership of the assets. Really, the question there is just the for-profit university own the key assets, or are there, for instance, several owners? Is it in a separate legal entity? If we're talking about a merger structure, who are all the equity or shareholders? Are there options outstanding? You'll need to review your corporate records and your documents. The issue there is what approvals are needed for any transaction you pursue. The regulatory process, and of course those required approvals, you'll need to file all the state and the federal approvals. Benefit plans, the question there is, can the nonprofit just use the existing benefit plans of the for-profit? If not, new plans will need to be created for the nonprofit. Real estate, is the real estate owned? As Jason mentioned, could that be retained? If so, then you would need a lease to be drafted. Any environmental issues, any outstanding legal claims, and last, as Jason mentioned, kind of a review of all your material contracts and debt instruments. You need to determine if those contracts will survive in the nonprofit's name, and whether that nonprofit will continue to receive benefits under that contract. The next is just a discussion and overview of what I'll call the definitive agreement, which is what you will sign with the nonprofit entity which will consummate your transaction, whether it be a conversion, a merger, or an asset sale. This document could be as long as 50 pages, and this is, of course, something that the lawyers will take a key lead on in doing. But let me just highlight some of the sections and what you kind of expect to see in this agreement, whatever form it might take. Again, either an asset purchase agreement, a merger agreement, or a plan of conversion. Of course, it's going to stipulate the sale and the purchase of the shares or the assets, purchase price, the form of in what form, if it's cash or in a kind of the terms of the promissory note. Promissory note form might even be attached. Your target closing date. There would be several representations and warranties concerning the university and the shareholders. For example, it's customary in any sort of disposition of a company to rep about the business. For example, list any pending litigation that the university might have. So you'd be required to list that. List any litigation that is threatened. List any of your material contracts. Those types of things. You're giving statements that need to be true on kind of the facts of the business. There will also be a shorter section on representations and warranties from the nonprofit. There'll be covenants, most notably how the for-profit university is going to be operated between the time you sign the agreement and close. Really, that just focuses on that the for-profit needs to just be run in the ordinary course of business. And then, of course, the purchase agreement will include closing conditions and termination, meaning either party can walk or get out of the transaction under certain specified events, such as if the valuation report from the appraiser came back either too low or too high, you couldn't get some approvals from the regulators, or a certain date that the transaction needed closed didn't occur on that date, either party could walk away. A very important section of the definitive agreement is the indemnification section. That's a very complicated, confusing part of the agreement, but very important. The idea is that the nonprofit is acquiring the university's assets and operations, and if those statements you made about the condition of those assets or the operations turn out not to be true, the nonprofit will have a legal right to recourse against the old owners or the university. An example of that is if the for-profit university, for example, forgot to disclose the existence of some pending litigation, and the nonprofit assumed that litigation via a merger structure, and then afterwards had to settle that litigation, the nonprofit could have a legal claim against the former owners of the university to get reimbursed those losses. As I mentioned prior, another key part of the principal transaction documents are what's called the disclosure schedules. These are an addendum to the purchase agreement or the definitive agreement, and they really lay out exceptions or lists to the reps and warranties and covenants of the agreement, and your accountants and attorneys will spend a lot of time with you going over them to make sure everything is disclosed in a proper manner. There'll also be a handful of ancillary agreements, particularly depending on what assets are retained in the agreement, but you'll certainly have your final valuation report, your promissory note, leases, any debt payoff letters, bills of sales, certificates, those types of things. Last year, kind of post-closing and closing integration, as Jason and Dick has mentioned, the nonprofit needs to be operated as a nonprofit at closing, and the governance structure must be in place. So there's a lot of required action items that the lawyers, the accountants, and your folks will need to be aligned on to make sure that all that can happen at closing. You'll have human resource issues to make sure you have all your benefit plans in place. Do you have your insurance coverage? Have you qualified to do business in all jurisdictions where you need to qualify? Are there appropriate name changes need to be made? Any press releases and other types of integration issues? But that's really a quick overview of the transaction process and what you can expect. And I think now we'll move to the Q&A section of the presentation. and review if we received any questions here. I don't see any questions.
Yeah, this is Dick Riley. I don't either.
So what we can do here, yeah, Dick, if I don't see a question either on our screen, what we can do is Jason could go into the kind of the last section of the presentation as consideration as a nonprofit.
That's a good idea.
Yeah, as if anybody does have a question, please, we're happy to interrupt this because I don't. It's just sort of an add-on here. So we did just want to put very short things here of thinking about operating as a nonprofit. We talked about the benefits, but you need to understand not only will you lose a substantial amount of control. The founder might be on the board of directors, and they may be an officer, they may be an executive, the executive director, president, or whatever you call it. But the answer is that the board of directors will have the ability to make changes, and they will be vested with that ability, as the members of the board of directors of a non-stock corporation, which means that they are not answerable to the shareholders. They are allowed to do their own thing. Another key important consideration is that nonprofit organizations in this country have to make a substantial amount of information public every year. Their annual tax return, which is a lot less like a tax return and more like a big summary of everything you did in the last year, and including disclosures about all sorts of conflicted or transactions with insiders. That's all available, publicly available on what's called guidestar.org, or under IRS rules, you actually have to make it available if someone were to show up and ask for it. The Form 1023, which is the initial application for exempt status, is also publicly available, and the college or the nonprofit would have to make that available to anyone who requests it. The other considerations is that we talked a lot about promissory notes. It's typical, I don't know, it could be that some of those payments, you may have a promissory note for a large amount of money, but remember, you've just sold the promissory note, and you've just sold the college to a nonprofit which does not have any other assets. And by the time the nonprofit, if it were to go kaput, by the time it figures it out, it may have burned through sizable amounts of its reserves, if it has reserves. So you're looking at a situation in which, whether those payments on the promissory note continue, they certainly are not guaranteed. So you are taking on some level of risk. The shareholders would be taking on some level of risk as to whether they would receive those payments. And then lastly, I think in this area, not only are we looking at additional scrutiny from the IRS, we're looking at additional scrutiny from accreditors, and then the media in this country seem to be active in this area as well. So you may have what we call more active levels of scrutiny. And then, ironically, at the same time that we've had higher levels of scrutiny from the media about for-profits, it turns out that once you're in nonprofit land, the taxes don't stop. So what the IRS did in 2013, or from 2009 to 2013, is they went around and they audited a number of very large, state and private universities and colleges. So the ones that have been operating as nonprofits for years and years and years, and they went and asserted a bunch of what we call unrelated business income tax. So they essentially said, you may be nonprofit, but we think you're taxable on a number of other different areas. So they audited them. They found $90 million in additional tax to be collected. So kind of ironic, but I think if you're thinking about areas in which you'd be subject to more scrutiny, one of the areas would be the IRS is looking for money even from the nonprofit areas. So that compliance project is available online. I've just done the very high level, and I think the key takeaway is that the IRS sees this as a fruitful area to do more audits and to collect more tax. So we'll see more of that kind of compliance activity in the future. And then lastly, for mainly historical reasons, the IRS wants to make sure that all 501c3 organizations, especially schools and colleges and universities, have a non-discrimination policy. It's actually required for schools and colleges and universities. It has most to do with desegregation efforts in the South in the 1960s, and then the creation of non-profit 501c3 schools, high schools, and below that level, of trying to make them basically segregated activities. The IRS came and said, well, if you're going to discriminate, we're not going to give you 501c3 status. That story doesn't have very much applicability to most institutions in today's world, but the IRS has carried over those requirements, so they have to be met, and they're not burdensome. I'm sure they're baked into I'd say almost all institutions that I've seen have something that's probably at a higher standard than this, but nonetheless the IRS does need to see this and other reporting on this type of thing. But again, I don't think it's really much of a burden except as an administrative matter. So with that, let's see here.
At this time, we're going to read the CLE code for this program. If you're in need of CLE credit today, please enter the 4-digit code into the poll question on the screen and press the submit button. I'm going to be announcing that now. The code is AZN7. That's A as in Alpha, Z as in Zulu, N as in November, and then the number 7. And again, please fill this out and click the submit button. If you're seeking Kansas, New York, or New Jersey CLE credit in addition to filling out this poll question, you will need to complete the attorney affirmation form and return it immediately following the program. A copy of the form can be found in the resource list widget, which is off to the left-hand side of your screen. I'm going to leave the poll open for another 30 seconds just to pick up anyone who needs that polling response.
And Dave, this is Dick Riley, one of your presenters. We did get one question that asked us, could we address in just a couple of more minutes on the benefits of nonprofit conversion from the gainful employment regulation perspective. And I believe the answer is the following. I did mention to the questioner, we are not, we are deal, tax, and nonprofit lawyers rather than the regulatory experts. So, any participant in this space, of course, needs to confer with knowledgeable regulatory counsel. But I do believe the answer to this is that the gainful employment regulations actually do not apply to nonprofit 501c3 educational organizations. They really are aimed at for-profit proprietary educational institutions. And I think as a practical matter, that is a driver of transactions in this space. It is an effort to be blunt about it, avoid the strictures of the gainful employment regulations. So I do believe that is a driver of many of these transactions. And it seems the short answer is, if the nonprofit conversion transaction, following all the procedures that Jason and David and I have discussed today, is successful, you should be able to avoid the application of those regulations because they don't apply to nonprofit 501c3s. So, and needless to say, in a complex area with a complex business, there's never a single consideration. So I have no doubt that the gainful employment regs are not going to be a driver for every company and organization. But I do think it is a driver. We know for a fact it is a driver for some.
At this time, the CLE poll is closed, and we will just strictly be taking questions. And I just ask that our attendees, at the conclusion of this presentation, a program evaluation survey will come up. We just would ask that you take a quick moment to fill that out. It does help us. We do read all the comments and scrutinize our ratings to make sure that we deliver the best presentations that we can here at Foley. So we'll just open the floor for any final questions, and we'd like to thank you.
Dick again. I did see one other question, which is, what are our predictions for for-profit schools? Are we going to see more conversions? I guess my answer to that would probably be yes, because particularly the gainful employment rules, but also just the general, legal and, to be honest, public relations scrutiny that the for-profit educational sector is under. It seems to me, as a practical matter, that is going to be a driver of for-profit to non-profit conversions. And, I think we're going to see that. As we've said, there are plenty of complexities, and it's not as though a non-profit conversion resolves every issue. The deal itself presents complexities, and, not everything is going to, it's not going to resolve all the issues. But it does seem to me that both legal and non-legal considerations are such that we are going to see, and maybe substantially more for-profit to non-profit conversions. That is all that I saw. So.
All right, and it does look like that is it. So we are going to finish up and close up the presentation now. We'd like to thank everyone for their attendance and wish everyone a pleasant day. Thank you.